is Mark. And Mark, what do you see for us today in the stock market?
Hey, how's it going?
Good.
Um, well, just looking on the site here, see if we're not coming on. It doesn't look like it's coming on.
You got to give it the 30 seconds, Mark. We're live right now, so start talking.
Okay. Um, all right. Well, I guess we got to start off with Apple. Okay, there we go. Yeah, I guess we got to start with Apple. All-time high. Um, Probably a little overbought. Wait a second here. Oh, yeah. Okay, so it got to an all-time high. All right, yeah, so this would be a good place to start. I don't know if I'm going to get a virtual reality mask, but you know, I mean, whatever.
$3,500 is a lot of money.
But this shows an interesting principle of markets that the good traders know about. And this is the importance of knowing where these price levels are. Now, you'll notice that Apple closed at 179.58. If we go back to January of 22, the all-time high was, let's see, about one. Well, I'm just going to look for an exact price. 182.88 was the all-time high.
That's crazy.
And we got above it. Now, there tends to be resistance at former peaks, and you can see that's the case here. It's not a coincidence that this is where Apple stalled out. It's because there was resistance back here. Now, why would there be resistance at a level that was resistance before? Well, it really has to do with buyer's remorse. You have people who bought back here who were upset that they did so when the price went lower, and they tell themselves, gee, I made a mistake. If I can get out of this, I'm going to. Let me get rid of this because this is actually an 18-month chart. So you have these remorseful buyers placing sell orders at the level that was a peak. So you get these remorseful buyers placing sellers, and if there's enough of them, then it can form resistance. Now,
so Mark, can I ask a question? Is there a limit back as far on the chart as far as people should look on a chart? I mean, you have to go back all the way. Really, you have to look left as far as you can to really get an idea of what the stock does and has done in the past. Correct?
Yeah, you want to look for former peaks, and I'm going to just because there's this thing called market memory, all right, and it means that an important price level can stay intact for a long time. Now, let me just show you on the CVS chart because this is a good example. So this is the CVS, the drugstore, just taking over the world. There's probably about 6 of them in a 3-mile radius of my house here.
Every street corner.
But look at this now. Okay, so this is market memory. Last February, we stalled out right around 111. Well, that's the same price we stalled out back in July and August of 2015. We can see here the $83 level was resistance for 2.5 years. The $77 was resistance for a year. 52 was support for a year. So these price levels, they can stay intact for a long time. So the answer to the question is just go back as far, if the stock's trading at an all-time high, you can't look for,
right.
There's going to be no support or resistance there. But you can look back as far as it takes because there could be a resistance level or a support level from 5 years ago that comes into play. And even if you're a short-term trader, if you're like a day trader, you should know where these levels are because if there's no news on a stock, the only thing that's really going to make it move is some kind of technical thing. Like it comes off of a resistance level or it comes off of a support level or something's overbought or oversold. So let me go back to Apple here.
And those levels usually happen at round numbers, right? Because of psychology.
People like round numbers. No one says, hey, sell it if it gets to 99.33 or, they say sell it if it gets to 100. And I want to look here at this concept of overbought. So we're overbought and we're at resistance. This down here in the bottom part of my screen is what we call the relative strength index. It's an index that measures momentum. Well, I don't know if it's probably misnamed. I don't think it's an index. It's what we call an oscillator. When this blue line gets above, actually, I'm going to just adjust this real quick here. So when the blue line gets above this red line, which I'm putting in there right now, It indicates overbought conditions. Now, what does overbought mean? Well, every market spends most of its time trading within what would be its typical or its historical trading range. If we get above that range, we call it overbought. And if we get below, we call it oversold. But this is important because if something is overbought or oversold, traders will come into the market because they're going to be looking for a reversion to the mean. So if something is overbought, momentum traders will come in and they'll sell because they're going to be thinking, oh, this is going to revert back to its mean. So we got this going on here. So that's going to probably draw some sellers into the market. I don't think we're going to have like a major sell-off or anything like that, but I think it's probably time for some profit taking.
So now, when these stocks get range bound like that, is there an amount of time? Is there a specific formula or a way that you look at that to determine how long it's going to stay range bound, or is it based just off a technical analysis and the way the chart moves along with price?
Yeah, I mean, there's really, it's like it when you see it, kind of a thing.
Right.
It's the thing about the market is this, right? A lot of people think that it's like this chess game, and it's not, because in chess the rules are always the same. The bishop always moves the same way. The rook always moves the same way. The market's not like that. The market is the market is an aggregate of investor psychology, and people are not rational. So chess would always be rational because the pieces always move the same way. Trading is more like a poker game in the sense that there's rules and there's strategies, but you have to understand that there's someone else on the other side of the trade. If you're buying something, someone is selling it to you. Or if you're selling something, someone is buying it from you. They have the exact opposite opinion of what's going to happen. Now, we saw here how buyer's remorse, which is a psychological thing, can turn what was resistance into resistance again. Now, if the market could have been figured out with math, it probably would have been done so by now. And, AI is really hot and it's in the news again. Well, about 5 years ago, it was the same thing. That's all we heard about was AI. And then for whatever reason, it kind of fell off the radar screen and now it's back. But back then, there's a lot of these funds started to manage money that were going to have strategies just based on artificial intelligence. There was going to be no, human decision making. It was going to be all artificial intelligence. And the performance on those funds has actually been pretty abysmal. It's way worse than the S&P. And that's because AI, at least in the market, I don't know about other areas, medicine and so forth and so on, but I know about it in trading. AI is based on statistics and probability theory, and statistics and probability theory say that people are rational. And as we know, people are not rational. If you look at when a market's moving higher, right, it's because there's not enough supply to fill the demand. And so the buyers are forced to pay higher prices. They have to pay premiums, and this forces an uptrend. When we get up to a resistance level, well, all of a sudden there's a lot of sellers around. In resistance is a large group of investors who are trying to sell at or close to the same price. So that's why when we're moving higher and we get to resistance, we stall out. Now, what happens up here is some of the people that want to sell notice like, oh, gee, the price isn't going up anymore. That means that there must be other sellers coming into the market. So a lot of these sellers get anxious that they're going to miss out because the buyers are going to go to whoever has the lowest price in town. Okay. That's what they're going to do. So if you want to sell, you got to have the lowest price. So these sellers start to get anxious and they start to undercut each other by cutting their prices. Right. So this move here, it's not because of psychology. It's not because of anything fundamental. It's not because of what they're saying on CNBC. It's human psychology. Something gets to resistance level, sellers get anxious and they start to undercut each other. All right. Now, the exact opposite is true if we get to a support level. And we can see here something interesting. Right. So notice how this resistance became support. But I'll talk more about that in a minute. Yeah. When a market is going lower, it's because there's not enough demand to fill all of the supply. And the sellers have to offer their shares out at a discount. This forces a downtrend. When we get to a support level, support is a large group of investors who are looking to buy. So some of these investors start looking around and they start to think, oh, gee, there must be other buyers coming to the market. That's why the price is not going any lower. And they start to get anxious that they're going to miss out. You got to be willing to pay the highest price if you want someone to sell it to you. If someone else is willing to pay a higher price, then that's who the sellers are going to go to. So you get these buyers that get anxious and they start to outbid each other. They bid higher prices. Like we got down here, someone might say, all right, I'll pay 125 for it. But someone else says, all right, well, I'll pay 125.10. And someone else says, oh, they're going to pay 125.10. I'm going to be willing to pay 125.20, and so forth and so on. So the point of getting at here is the vast majority of these moves in a market are based on psychology. They have nothing to do with like what they're ranting about. I mean, earnings, things like that move stocks, but no one out there is trading is really paying attention to what's going on in Ukraine or this, that, the other thing. The media feels as though they got to give every little thing, every little movement in the market's got to be tied to some fundamental.
Well, it fuels speculation. So, you get this people pumping up stocks, or not pumping, I guess, but just talking about them, highly valuing them on the news media, and then it makes this price spike. So it's all about emotion, really.
Yeah. My advice to people is just don't even watch the media. Let the market tell you what to do. All right. So I'm having trouble typing here. Let's see. SPY. So pretty much in the institutional trading world, at least where I was, we have a meeting every morning where we talk about what's going on and we go through the different sectors and we go through the news. And from there, we come up with our investment ideas. So the first thing we look at is the S&P 500. So this is actually SPY. This is the S&P 500 ETF. This is what most people trade. So this is what we look at, but it looks exactly like the S&P 500. And we can see here, we're getting close to a former resistance level. Looks like we're kind of hitting some resistance here. This was the peak in August, 430. So and now we got to understand that this consists of 500 stocks, which is why it's named the S&P 500, but there's 11 sectors, and we can go through the various sectors to come up with our trading ideas. For example, if you see a particular sector, I don't know, just say utilities is extremely overbought and it's at resistance, there's a good chance utilities are going to go down. So then we can look within the utility sector for the particular stocks that look the most compelling. So the first thing we start off with is the tech ETF, XLK. This is the biggest sector in the market. And I mean, this is pretty overbought.
Large.
So this illustrates an important thing here I want to show our viewers. Notice how these like I mentioned, certain price levels are more important than others. That's just how the market is. Sometimes we know why. Sometimes we don't know why. Now, markets don't go in straight lines, right? They go in like staircases. They have a succession of trading ranges. And if we're going higher, each trading range is higher than the previous one. So notice how here we have resistance, and this became a support level, right? So we go higher. All of a sudden, there's a lot of sellers here. Market goes lower. But then when we get higher, a lot of the sellers who bought here regret doing so. Sold here, regret doing so because the price is higher. So they tell themselves, hey, I'm going to buy my shares back, but I'm only going to do it if I can get them for the same price that I sold them at. So you have these remorseful sellers placing buy orders at the level that was resistance. And if you have enough, resistance can convert into support. So for some reason, this 130 level is important for XLK. It's not 131. It's not 132. It's right here around 130. Notice the same thing happened here again. Resistance became support.
Mm-hmm.
So this is the 135 level. Resistance became support. This is, I would say, the 144 level. Now, this is going to kind of key us into where the market's going to go over the next few days or week or so. Notice how resistance has, for the time being, maybe it's becoming support. But if this turns around and XLK gets back down through this level, I would suspect we're going to get a pretty decent sell-off. I'm not saying the market's going to crash or anything like that, but the best traders let the market tell them what to do. They don't come in with these preconceived notions. It's like, all right, well, no one really knows what's going to happen in the future, unless you're a psychic, right? So we just watch the market for clues. Now, right now, probably the main thing I'm focused on in stocks is what is going to happen up here. So this is 163.50. We could see we're at 165.72 in the pre-market. So it's pretty much right there. So we get some selling in Apple or Microsoft, some of the other tech stocks. There's a good chance this level breaks, and then we get that'll be the market telling us like, hey, I'm about to go lower.
Mark, we've got a question here from Avi Barak.
Okay.
Does volume affect the price action?
Well, I really don't pay attention to volume too much. Price action is more important, but there are two things I'll look at with volume. One is something liquid enough for me to suggest buying it. If something only trades 1,000 shares a day, then you probably want to stay away from it. The other thing I look at is what we look for is called a capitulation volume. And it might be the case here. So this is advanced auto parts. This is a longer than a 2-month chart. So let me just fix this here. I look for stocks that have capitulations. And I will explain what that is in a second once I add my volume here. The thing is this, right? There's this notion that volume confirms the trend. And, I've heard that, I've read it in various books and so forth and so on. But in my experience, something can trend for a long time on declining volume. So that's why I kind of don't really make it the top of my priority list. But this here is, notice this huge volume when we had this. This is the most volume that ever traded in the history of advanced auto parts. And the stock has been around for, I think, 23 years. This could be a capitulation. Now, what happens is you get investors or traders who want to sell, all right? And just say you get an order, the stock trades 5 million shares a day. Just say you're some institutional trader and you get an order to sell 1 million shares. And the stock is trading at 120. So you sell 100,000 at 120 and you kind of wait to see what's going to happen. And you tell yourself, all right, I'm going to sell another 100 at 121. But it starts to go lower. So you say, all right, well, I'm going to have to sell another 100 here at 115. So you've sold 200,000 shares, but you still have 800,000 to go. The price keeps going lower and lower. Finally, what the traders do is they capitulate. They just say, you know what, enough of this. I'm sick of watching this thing go lower. You tell your broker, just go sell it all. Just go get rid of it. And as a result, you get these big volume spikes like this. Now, the reason why this is important, and it might be, notice I said might, right? It might be a bullish thing, is because if it turns out that this news is not as bad as people thought initially, and we have investors saying, I'm going to take advantage of this weakness. I'm going to go into the market and buy. Well, there's not going to be a lot of sellers around because they all finished and left the market. So if you want to buy, you're going to be forced to be willing to pay a premium to entice sellers to come in off the market. Coming off the sidelines and into the market. And that could set the stage for a move higher. That would force an uptrend. Now, I wouldn't get into this yet. The way I would approach this stock is just because something is down and it's oversold, it doesn't mean it's not going to go down farther. People really just try to guess, and that's called catching a falling knife. And it's a good way to get run over and to lose money. You got to have a reason for doing things. One of the main reasons why I've heard anywhere from 70 to 90% of retail investors end up failing. And one of the main reasons why is because they just guess. Now, this is set up for a potential reversal. It's down big, it's really oversold, and we had a capitulation volume. But what I would do is I'd wait for the reversal to actually start and then jump in. You're not going to get the bottom price, but I would look, like this day here, the opening price was right around 68.50. So if we start to bounce, so we get back up above 68.50, well, then that's where I would jump in. And this is a common strategy of momentum traders, is to just wait for something to start moving one way or the other and then jump in, as opposed to trying to get the specific or exact bottom or top.
So, Mark, with the size of the gap there from 65 to 120, I guess that is. So what about 113? Yeah. So you could pretty much buy options in that entire area, anywhere in that area. Once it starts to make that break, they usually fill, correct?
Yeah. Yeah. It's not a guarantee, but what happens is if something is going one way and it gaps through it, if the price eventually reverses and comes back the other way, they tend to make rapid moves. And the reason why is because there's not a lot of vested interest. One of the main reasons why we get why we get resistance is because we have remorseful buyers trying to sell to get out at break even, like we've seen. If something gaps through these price levels, it never traded there. So if it never trades there, then just by definition, you can't have remorseful buyers trying to sell. So when the price goes higher, buyers that are coming into the market are going to have a hard time finding sellers. And as a result, they're forced to pay a premium. Like the stock could be trading, the last trade might be 68, but there might only be 5,000 shares offered at 68. If you want to buy 100,000, you might have to buy, you buy the 5,000 at 68. But to buy the rest of them, you got to pay higher prices. And this is what forces the price up. It's all about supply and demand, right? If you can understand supply and demand, you can understand how to read charts. I think a lot of technical analysts are really pretty bad, frankly. And that's because they don't really understand these principles that I'm talking about. They just kind of look for patterns without even realizing or understanding what it is the pattern illustrates. So I tell
I'm sorry. So as an institutional trader, Mark, when this AAP starts to make its move and shows you that it's going to make a reversal, how do you buy into that? If say there is 10,000 shares available today and you have a million share order that you have to fill before it gets to 90. How do you do that?
Well, you got to call around. This is something a retail trader can't do, but you call it around to your different brokers. See, if you're an institutional, what we call a buy side trader, you have to pay a commission to get a trade done. And it's confusing because it has nothing to do with buying or selling. The buy side is the place that has to pay a commission to get a trade done. These are your retail traders, your hedge funds, your mutual funds. The sell side are the brokers. They receive a commission to get a trade done. So if I'm a buy side trader, which I was, I have to trade through the sell side. I have to trade through the brokers. That's just how it works. So what I would do is I would be calling around to my different brokers and saying, hey, what do you see on AAIP or AAP? Doing anything? And, they want your business. So if they see something, most of the time they'll let you know, oh, we got a large buyer here. Are you looking to do anything? Now, on the buy side, a lot of times you don't want to let people know what you're going to do, right? So this concept of what a market maker is very misunderstood. It's one of the things I've realized since I've been in this retail world. A market maker is simply a trader who works at a sell side firm that has a specialty in a certain industry or a certain area. That's what they do all day, is they just trade those stocks. So say I have an order to buy 1 million shares of AAP, and I call over to, just say hypothetically, Goldman Sachs, and I say, hey, look, man, let me talk to your market maker, or relay to your market maker. Hey, I'm looking to do something on AAP. And they're going to be like, well, what are you looking to do? They're going to try to feel you out. And I'm going to say, well, you got anything going on? And it kind of goes back and forth. It's like this cat and this mouse thing. Finally, I say, I don't want them to know if I'm a buyer or a seller. So finally, I say, all right, listen, I got something to do on 1 million shares. Make me a market. And the market maker might say, all right, we closed at 65.80, or we're at 65.80. I'll buy 1 million shares from you at 65, and I'll sell you 1 million shares at 67. And that's where the term market maker comes from. They made a market. Market makers don't go out every morning thinking, oh, gee, how can I go rip off the little guy? 90% or 95% of what market makers do is working orders for their institutional clients. So I would call around and, you get the feel. It's like if most of the brokers you talk to don't see any sellers, but they see other buyers, well, then that kind of tells you got to be aggressive because you want to get ahead of them, right? If you see a lot of sellers around, if everyone you call is like, oh, listen, I'm better for sale, or I got 5 million for sale, or I got this for sale, well, then you kind of get the sense that it's not going to be going any higher, so you don't need to be too aggressive. So it's a big cat and mouse game, and it's very relationship oriented.
How often do you get to where, are there times where you can't fill the order?
Yeah.
Really?
Yeah.
So then what happens then? The client just lose out, or is it just something that you're just not able to book?
Well, it would all depend on what the portfolio manager does. The portfolio managers make the decisions as to what's going to be in the account. So if you get an order to buy 1 million shares of something, and let's just say it's really illiquid, and you can only buy 20,000 shares, and then the thing shoots up like 3 points. some portfolio managers might say, well, you know what, let's just be patient. And if it gets back down to our price, we'll try to buy more. Some might say, you know what, this is such a little position. It's just not worth our time. We could sell it at a profit here. So just blow out of it and we'll just keep an eye on it.
Awesome. Cool.
It depends on people's style. If they're what we call like a fast money trader, which is people that trade with very short time horizons, they would probably blow it out. If it's someone who's like a long-term buy and hold strategy, they're probably going to say, all right, well, let's just keep our 20,000 shares and let's wait and see if it comes back to us. And in that case, we'll buy more. So every situation's a little different.
Thank you.
You know what I wanted to look at is oil, because there's a lot of talk about oil. The stock market looks like it's going to be pretty quiet, at least as of now. But oil is trading down. And even though OPEC said that they're cutting, but that's all right. Now, look at this. We see here we have our potential, our levels, right? This black line here is about 74. We can see that was resistance. Let me just clean this up a little here. We could see we sold off and we got to this level. And then when we sold off again, where did we find support? Right at the same level. It's all about understanding where these price levels are. We got up here to resistance. And what happens? We start selling off. So we're in the middle of a range. If we get back down to this line here, which is, I would say, about 68, well, there's a good chance we bounce again. Now, you might be saying, all right, well, I don't trade oil futures. Well, you don't need to. There are ETFs that you could trade that track oil. Like one of them is this XOP. This is our Spider Oil and Gas ETF. And you can see here, look at where the support is here. So if oil goes lower and gets to that level and starts to bounce, this is probably going to follow right along. So you can get exposure here in this ETF. You could get exposure in, I think it's USO, right? The United States Oil Fund. This is an ETF that's also designed to track oil. So it doesn't track it perfectly for reasons that I won't get into because it can be pretty complicated, but it's close enough for our purposes. So if you watch oil, it gets down, it looks like it's going to rebound again, you can just buy this here and this will track it. So this is a way to get exposure. We talk a lot about commodities, and some people think like, well, I don't really trade commodities, but they shouldn't be afraid of them because there are ETFs that we can trade that just track them. You don't need to trade futures. You can get exposure to corn or to wheat. As a matter of fact, let's see what corn's doing. So this is the ETF is appropriately enough. The symbol is corn. And this is designed to track corn. And we could see here some of the principles that exist in pretty much any market. Here's a new situation where what was support becomes resistance, right? People bought here, and when the price went lower, a lot of these people tell themselves, I made a mistake, I want to get out, but I don't want to lose any money. So if it gets back up to the same price that I bought at, I'm going to sell. And if you have enough of these remorseful buyers placing sell orders at the level that was support turns into resistance. So we saw that in some of our stocks. We can see it here in commodities. What else is there? There's the wheat ETF.
We're going to get a question from YouTube. If you could please check EEM when you're done.
All right. So yeah, so kind of this, you can see kind of the same principle here. Well, with support becomes resistance. Knowing where these important price levels are, I think it's kind of analogous to like having a map. And if you go into a place where you've never been before and you don't have your GPS and you don't have a map, well, you're going to have a hard time getting around. And so you don't know where these price levels are. You're going to have a hard time trading. So look at that. So resistance was resistance. Support becomes resistance. Support becomes resistance. So let's look at EEM.
With the war the way that it is, since that's like 30% of the breadbasket of the whole world, wouldn't wheat be extremely high right now if there was that sort of wheat problem?
Well, I guess other parts of the world are probably growing it, and I think they are exporting it. But I'm not really sure. I mean, I know wheat was.
I'll dig more into that.
Wheat really took off when we had the war broke out, but that was kind of panic buying,
right?
And I don't think that was. like traders buying it. Those are people who actually need the wheat. Like say you're, I don't know, General Mills, and you need wheat to make your Wheaties or whatever, whoever makes Wheaties. You if you can't buy it, it's going to mess up your business. So those were people that were kind of just buying because they were afraid that they would, miss out on supply. And like most things, it got overdone to the upside, and within a week or two, it came right back in.
So now something like that where Procter and Gamble or General Mills would have to buy up on wheat. How long would it take that to show up in the financial balance sheet? Would that be like 3 months down the road, 6 months down the road, or would the inflation have to correct before they actually saw how bad that hit them?
Well, it would probably be. I would think it would probably be in their quarterly statements. You can get an idea of what they're doing,
Of how
and
bad it's going to hurt.
yeah, and if not quarterly, it would certainly be in the annual statement. Um, all right, so we can see here pretty clearly that this $38 level is support here, and I just want to look at some of these market principles. One of our principles is you can see here we got really overbought, and then we came back in. All right. Let's see. Over here, we got really oversold, and that was right before we bounced. Remember, overbought and oversold conditions draw buyers and sellers into the market. So they're going to be anticipating a reversion. So you'll get people coming in and shorting it, or you'll get people who need to sell. It'll just say, hey, I'm going to take advantage of this overboughtness because I think it's going to go lower. And they're going to come into the market too. So when something gets oversold and gets to support, there's a good chance it bounces. When something gets overbought and gets to resistance, there's a good chance it sells off. But I would say I would be probably kind of neutral on this. If it got back down to here around 38, that's where I would consider maybe buying. And if we got up to around here, around 40, where is it now? 39. So it's pretty much right there. It's only 39.44. So it's pretty close to resistance. I would say if it got up a little bit more, maybe around here, that's where I would consider selling. So that's what would be my take on this EEM, emerging markets.
Hope that helped you, McDally.
All right, let's just take a look at the headlines. I got a 8:45 meeting I have to go to, unless we got a lot of questions. Ooh, you see they blew up that dam over in Ukraine?
No, I did not.
Yeah, dude, it's like let's see, destruction of Ukraine dam floods frontline. It's like in World War II, they had the dam busters.
Yeah.
Speaking of World War II, today is D-Day, so I hope everyone thinks about that. And that's one of the Kennedy brothers was on one of those dam buster bombing plane, and I think the plane blew up, and he died. So he died during the war. I mean, I'm not like a big Kennedy fan, so I don't really know which one it was.
It wasn't John. He was on a PT-109. His actual boat was PT-109. It was a torpedo boat.
I think it was Joe Kennedy that died on the plane. Joe Kennedy Jr. So that family's had a lot of tragedy. Yep. All right, let's see. So then we look through the news just to see if we can find something that might give us some trading ideas. Oh, let's see what's happening with Binance, because this is seem like some pretty serious charges here. So let's see. What does the SEC suit against Binance matter? I'm going to go look at.
Share your screen.
Oh, sorry. I'm going to. I just want to take a look at Bitcoin. I think that, in my opinion, that this crypto thing is going to, keep going on. I don't think it's close to being over in terms of, scam, bankment, fraud, and this other thing now with Binance. I mean, the allegations are pretty serious. It's like, commingling funds, lying to regulators. All right, so here's Bitcoin, and we could see it made a big move lower on this. And we can see here we had a level that was support, and it became resistance here, right? Support can become resistance. If we go back, we can see a lot of these same principles illustrated on the chart here. where support here, oops, support over here became resistance over here, right? Oversold and we bounce. And the reason why in these different markets, whether we're talking about commodities or cryptos or stocks, the reason why we see these similar chart patterns is because a chart pattern is just a sign of human psychology. It's a graphical illustration of human psychology. And we have humans that just have different time frames. Well, actually, different trading things, right? So people that are trading Bitcoin are human. Well, I guess for the most part, people that trade stocks are humans. We have our emotions here. Support here became resistance there. It's the same thing that we saw in the stock market. It's the same thing that we saw in some of the commodities markets. All right, so that's Bitcoin. Let me go to, I want to go check out that article. It's in the Wall Street Journal.
So a little bit what we're trying to do here is I'm a bail bondsman, have been for 24 years, just a recent trader. So I'm kind of on the retail side of this. I'm kind of your perspective from the retail side. Mark is, of course, your institutional micromanaging guru. I call him Magic Mark because he's just bad like that. And so we're going to try to give you a show that gives you a little bit of an entertainment. We're going to run B-rolls every once in a while from when I have to go pick up a defendant and put them back into jail. We're going to have interviews with other bail bondsmen to kind of give you an idea of how the industry works and how things work. Mark's going to actually bring people on and interview them about the financial markets or vice versa. He may interview the bail bondsman. I may interview the financial guru. And we're going to try to give you some entertainment every day. And we hope that you will stick around with us. And just a little bit while we do that, Mark will go through the news.
So how does the bail bonds work? So I get arrested and they say, all right, you got to sit in jail unless you can get bailed out.
Yeah, in Florida, so everybody has to go in front of a judge. So if you're arrested for any kind of offense now, we used to have what's called preset bonds. And then this was a 24-hour business. But now most bonds have to be seen by a judge in the morning. So the defendant will get up, say 7 o'clock or whatever, when they wake them up in jail, and they'll be arraigned in front of a judge. And then the judge will tell them whatever their bond is, read their charge out. And the charge is usually written off of a minimus, which is kind of the documentation that the police officer uses to write up his report while he's, arresting you. So the judge will read that, take that opinion, form his idea of what your bail bond should be, and then he sets a bond. And so then from that point, then the family has to get a hold of the bail bondsman and make arrangements. The defendant can get a hold of the bail bondsman, but that's not how I do it. So the defendant or the indemnitor will reach out to the bail bondsman, make arrangements to pay 10% of the face value of the bond, and then the bail bondsman stands good for for the full 100% if the person doesn't show up for court. But in that, we have the right to arrest wherever, whenever, and however they are, if they break a law or if they go against what was in the terms and conditions of their bail bond, or if they commit crimes that are anything more than a minor traffic offense allows us to rearrest them if we have to. Now, that's not a policy that I live off of, but from time to time, I mean, you have to put people back into jail when they act like they're going to run.
So do they have to pay you back that 10%?
The 10% belongs to me, but it belongs to my company, but the insurance company is paid out of that. So basically in Florida, there's an insurance company that stands behind the bail bondsman. And so your agency writes for an insurance company, and then you give them the money. At the end of the month, they give you back what you're allowed to keep. And it's basically like you're buying an insurance policy. But then you actually have the agent, instead of being like a Geico agent where I can just write you a car policy and never answer the phone again. If you don't do what's right by me, I have to come find you, or I physically have to pay the money to the court to cover the bail bond. So that's the whole point of doing it with the indemnitor. I call it my triangle of indemnity. And it means this defendant that's in jail doesn't know me. I don't know that defendant, but that mom or that dad that defendant is part of, that has the collateral or has the, just the wherewithal not to go to jail and to be responsible somewhat, then that's the person that you make responsible for the bail bond. So, this is just, it's kind of how it is. And I hope to really be able to find some bail bondsmen that we can interview over the course of time so that you can learn a little bit more about the industry, because it's a pretty fascinating industry. We're in the gray. We're not police. We're not criminals, but we kind of have to work with both.
like Dog the Bounty Hunter.
Well, no, come on. If you mentioned that name, I don't really like Dog. But he's a fine looking fella, but I don't know that I would do it his way.
Well, it's probably all that stuff is probably fake anyway.
Yeah, he's TV'd it up quite a bit.
Yeah.
I've never been that nice. I don't pray with them. I'm a Christian. I don't pray with them. My whole goal is to gather them and put them back where I took them from as quick as possible, with as few words as possible, and as little violence as possible if we have to, but violence is sometimes necessary.
Yeah. All right.
It's an interesting job.
Yeah, it sounds like it. All right. I just see this article here. It looks pretty interesting. And you've probably heard a lot about this. There's been a very, what we call like a narrow rally or narrow market, meaning that the market is being lifted by just a very small group of stocks. The S&P 500 is 500 stocks. So that's where the name comes from. But the S&P 500 is what we call a market capitalization weighted index. If you take just 4 stocks, if you take Microsoft, Apple, Google, and I think Amazon, that's almost 20% of the market. So what could be going on is people are selling. Most of the stocks in the market are going lower, believe it or not. So people are selling, and the money is just flowing into those big names. And if you're into those big names, then that's great. But it could show a sign of market weakness because all the stocks aren't really moving in the same direction. I'm going to show you something from the end of 2021, right where the bull market was coming to an end. And this is how one of the reasons why we started to get bearish. What's going on here? Hold on one second here. All right, so this is the Qs, right? This is the NASDAQ 100. This is a market capitalization weighted index. So Microsoft and Apple are probably 20% of this, and it's 100 stocks. So in theory, 70 or 80 stocks could be going down. And if the people are taking the money they get out of those stocks and they're putting them into the big stocks, it could make the broader benchmark or the broader index go higher. But it could be masking some underlying weakness. Now, this is the Qs, right? This is December of 2021. Notice where it peaked, right here, December 30th. So right at the very end of the year. If you looked at this other ETF, it was QQQE, this has every stock in this equally weighted. It's not dominated by Microsoft and Apple. Notice where this peaked. This peaked in November of 2021. So this peaked like a month before the broader market peaked, and then the broader market went lower. So this was a sign of what we would call deteriorating internals. You want all, like, I guess a good analogy is like, it's the soldiers, right? You got 500 soldiers. If you only got, 10 of them are moving forward and the other 490 are moving backwards, well, then the ones that are in the front are probably going to eventually turn around. For a healthy market, you want all the stocks to kind of be going in the same way. Now, let's take a look at, or go back to our S&P 500 here. Right. And let me just bring us up to where we are now. All right. So that looks like, the market's been going higher, right? Obviously, you don't need to be a market guru to see that. Here's an ETF where everything is equally weighted. Like I said, this ETF, this 500 stocks, but 4 of them are about 20%. So those are going to have a really powerful impact on the broad benchmark. So there could be a lot of stocks going down, but because the money is floating into these big ones, it's making the broader benchmark go higher. There's this ETF, RSP, that is an S&P 500 equal weighted. So let's look at this. So this is actually not really doing so well. So this shows us here that most of the stocks in the market have been going down. There's the peak back here. Now, at some point, this will probably come apart. I don't know when. I suspect that next week. My guess is that the Fed raises rates, and this whole narrative of, they're going to pause or take a break is going to be kind of thrown out the window. And the reason why I say that is because the numbers, the economic numbers, the job numbers on Friday were so strong that it shows that the economy is doing well, and a good economy is an inflationary thing. So I don't see how they don't raise rates.
So, Mark, the difference with these different type of like the equal weighted and the unweighted SPY. So, how do you use these to? I mean, I guess you're telling us now that we can use this chart to take a look at the SPY and see exactly the actual the way the SPY is acting and what's going to happen with this chart. So, how do you use these different these equal weighted, unweighted, overweighted? What does all that mean?
You look for divergences. Now, let me just show you. I'm going to go to the SPY. Um,
I hope that wasn't too broad a question for you.
no. You look for divergences, right? If when they start heading in different ways, that tells you that something is going on. So here's our S&P 500, and we can see Apple is 7.5%, Microsoft is 7%, Amazon is, well, let's see, Google. Oh wow, look at that, Nvidia is up to 2.7. Google is 4. So Apple, Microsoft, Amazon, and Google are about 20% of this. Okay.
Okay.
So it's 500 stocks. Then you only got 4 of them are, 20% of it. So theoretically, 400 stocks could be going down. And if that money is going into these big guys and pushing them higher, that could make the broader benchmark rise, or that will make the S&P rise. But it's masking the fact that there's some deteriorating internals going on. So what we do is we look for a divergence in these things. If SPY is going one way and RSP is going the other way, well, that tells us that SPY will probably reverse pretty soon. If they're both going the same way, then that's great, right? It's you got all like all the members of the team are kind of moving in the same direction. So this is a pretty, people have been talking a lot about this, and like we saw back there in 2021, they tend to precede sell-offs when you have most of the stocks going down, because when people are done selling and there's no more money left to be put into the big ones like Apple and Microsoft, the only way they can go is down. Markets go down when they run out of buyers, right? And if people are extremely bullish on these AI stocks, well, what are they going to do? They're going to go and buy them. If we have the vast majority of investors are bullish on them, what happens? They go and they buy them. And then when they're done with their buying, there's no one left behind them. The market runs out of buyers, and the only place it can go is down. So that's when I think a good analogy is when people who don't buy stocks are buying stocks, there's no one left behind. And, I mentioned the Kennedys before. The famous story is that Joe Kennedy, he was back in the 20s, what you would call probably an equivalent to like a modern day hedge fund. What's a hedge fund manager? He was going to work one day, and the story is that the shoe shine boy started giving him stock tips, and then he went to work and he sold all of his stocks, and he went short everything, and then the market crashed, and he ended up becoming extraordinarily wealthy. And I think he just thought if shoe shine boys are buying stocks, then there's no one left behind them in the pecking order to push the price any higher. So that could be going on here. This is why when people get excessively bullish, it tends to be bad for the market. And when people get excessively bearish, it tends to be good for the market. So here's our different sectors that we look at. All right, let me just show you guys one more thing before I got to cut out here. I'm going to just show you an interesting principle that could help you. We mentioned it a little bit before, but it's really clear on this chart. This is the industrial sector. XLI. XLI. Now, this is, you don't really need to be a market guru here to see that we got clear resistance and clear support. So we're going lower. We get to support, and investors start to look around and say, hey, the price isn't going any lower anymore. That must mean there are other buyers coming into the market. So they start to bid higher prices than each other, and you start the snowball effect. You get up to resistance and the opposite happens. People want to sell and they say, you know what? The price isn't going any higher. There must be sellers coming in. Gets to support, rallies, gets to resistance, sells off, gets to support, rallies, resistance, sells off. Again, this is not based on what they're telling you on CNBC or, you know, whatever fundamental story they're trying to attribute it to. The vast majority of moves in the market are due to this psychology. We get to resistance and anxious sellers push us down and we get a snowball effect. We get to support and anxious buyers start to get worried that they're going to miss out and they start to outbid each other, and this pushes the price higher. So if you know where these important price levels are, it'll help your trading because it gives you an idea of where to put your orders. For example, say you bought down here and you tell yourself, oh, I'm going to sell if it gets to 102. Well, it might not get to 102. If you let the market tell you what to do, you would have looked back and you would have seen, oh, there's resistance around 101. So instead of selling at 102, I'm going to sell at 101. It's not as good as selling at 102, but it's better than missing it.
All right. Well, Mark, thank you. Folks, this is me. This is Mark Putrino, Professor Mark Putrino, CMT. I'm born to be free. And if you need us at all, you can reach out to Mark at stockmarketjobber.com. There's his email address. We are available for you however you need us. And thank you for watching today. We hope you come back and visit with us again tomorrow. Have a nice day.
All right. Thanks, everybody.